Today, we're going to pull back the curtain on a hidden architecture in our financial system. It's a concept that most people have never heard of, but one whose consequences could quietly, and I mean quietly, define the next decade. This is permission denied.
And right there, that's the whole ballgame. We're all conditioned to look for that big, explosive moment, a Lehman Brothers style collapse that screams crisis on every news channel. But the argument we're exploring today is that this time it's not going to be a sudden crash. No, it's going to be a quiet, systemic freeze that unfolds in layers slowly, almost invisibly, long before it ever makes the 6 o'clock news.
Before we jump in, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. All right, let's get into the mechanics of how this all works.
Okay, so we have to start with a really dangerous assumption that pretty much all of us make about our money. We believe, deep down, that our assets are safe and that they're always accessible. But the reality is, that feeling of safety, it's just a temporary condition. It is absolutely not an ironclad guarantee. Now this slide really frames the difference perfectly. Think about 2008. It was loud, right? It was chaotic, obvious. A sudden collapse that created mass panic. You couldn't miss it. The crisis architecture we're talking about now is the polar opposite. It's a slow squeeze, a quiet process of attrition that's caused by something called systemic friction. So you see, it's less like a sudden heart attack and a lot more like a slow, creeping suffocation of the entire system.
So that brings us to the word itself, liquidity. We all think we know what it means, but our definition is where the problem starts. We think of it as a constant state, but it's not. Look, when you deposit money in a bank, they don't just put it in a little box with your name on it. No way. They deploy it, they lend it out, they invest it. Your balance is just an entry on a ledger. The actual physical availability of that cash depends on the entire system functioning smoothly. And when that system starts to slow down, well, that's when the difference between money on paper and money you can actually get your hands on becomes everything.
Okay, so this brings us to the core mechanism. How does a system so massive, so interconnected actually seize up? It doesn't happen with a big bang. It's not an explosion. It's a gradual slowdown, a loss of velocity that quietly, transaction by transaction, grinds the gears of the economy to a halt. And this right here, this is the key. Friction. It's not about banks just failing overnight in some dramatic fashion. It's about the whole system becoming less efficient, more cautious, and just slower. Suddenly, every transaction, every loan approval, every wire transfer requires more effort, more time, more scrutiny. And this friction, it's cumulative. It builds on itself, layer by layer. And here's what that friction actually feels like for you and me. These aren't dramatic headline-grabbing events. They're subtle, they're frustrating, and they're totally deniable. Your wire transfer is suddenly held for a temporary review. Your home equity line of credit, your HELOC, is just quietly reduced without any warning. You apply for a business loan and it just stalls. It gets stuck in underwriting with no clear explanation. See, each of these steps by itself just seems like a pain, like some bureaucratic hassle. But when you put them all together, they are the clear symptoms of a system that is rapidly losing liquidity.
And this is the end game of all that slow, grinding friction. By the time a government agency or a major bank actually issues an official statement, about temporary restrictions or new consumer policies, it's not a warning. It's a confirmation. It's an announcement that all those quiet, unofficial restrictions that have been building for months are now permanent policy. The window to do anything about it? That has already closed.
Now look, if hearing this is making you a little uncomfortable, that's probably a good thing. Because feeling discomfort now is a heck of a lot cheaper than feeling shock later. Before we continue, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, now let's look at what breaks first. So where does this whole thing start? Where does the collapse actually begin? Well, it doesn't start at your local bank branch. It doesn't start with your credit card. It starts deep in the plumbing of the financial system, in the markets where the big banks and the massive institutions do business with each other. This slide here shows the chain reaction perfectly. It all starts when the big institutions stop trusting each other. First, the repo markets. That's where banks get their critical overnight loans. They start to freeze up. Then interbank lending stalls. So when banks won't even lend to other banks, money just stops moving. And that's when it finally hits the real economy. Business credit lines evaporate. And then consumer credit lines, things like those home equity lines of credit, HELOCs, they are frozen instantly.
At this point, of course, all eyes turn to the central bank for a rescue, for a bailout. But the source material we're looking at lays out a total nightmare scenario. A trap, really, where every single policy choice leads to a disastrous outcome. The policymakers are faced with a brutal, almost impossible choice.
Let's just break down this dilemma because it's so important. Option 1, they cut interest rates to try and inject liquidity to save the system. What happens? They risk igniting uncontrollable inflation. Okay, so what about option 2? They hold rates steady to fight that inflation. What's the consequence? They allow the liquidity collapse to accelerate, completely fracturing the credit markets. There is no clean exit here. There's no good option. The system is forced to choose between stability and access. And if you look at history, it will always, always choose to stabilize the core institutions, even if that means restricting access for everybody else.
So what on earth does this mean for a tangible asset, something like real estate? The source uses this powerful metaphor. The market doesn't experience a sudden 2008-style crash that's driven by everybody panic selling. No. Instead, it's starved of the one thing it needs to function, credit. It's starved of its oxygen. It suffocates. This is what that suffocation actually looks like in practice, on the ground. It becomes nearly impossible to get a mortgage approved. The process slows to a crawl. Appraisals start coming in consistently low, which kills deals left and right. The cost to even insure a property suddenly surges, and for anyone who already owns a home, refinancing becomes impossible, trapping them with rising costs they can't escape. This all leads to a quiet, steady increase in forced sales. This isn't panic. The source calls it attrition, a slow, grinding decline as the entire market is just starved of credit.
And that brings us to the final outcome of this crisis. And listen, it's not a total collapse where everyone loses equally. No, it's a selective managed event where access to money and credit, that becomes the dividing line between who is saved and who is sacrificed.
And this table just lays it out in stark black and white, doesn't it? The systemically important institutions, the ones that are too big to fail, they get saved. They are backstopped, they're stabilized. But who gets sacrificed? Well, it's those on the other side of the ledger. Small businesses that rely on credit lines just to make payroll, and households that are over-leveraged. The system doesn't actually break, it consolidates. The risk gets transferred downward, and ownership of assets becomes much more concentrated at the top.
The aftermath of all this isn't chaos, it's control. It's the normalization of a new, stricter reality. New, much tougher lending standards are put in place. The very definition of what a safe asset is, that changes. And in this new environment, having access to liquidity, to actual cash, is no longer a given. It becomes a privilege. Opportunity will heavily, heavily favor those who managed to stay liquid through the crisis, while those who didn't are pretty much permanently locked out.
As we get to our final thought here, if you understand the stakes we've been talking about, please like, subscribe, and share this information. And if this has you thinking about your own strategy, whether that's making housing decisions, relocating, or just protecting your family, check out the links in the description. My team and I can help you with your real estate or life insurance needs anywhere nationwide. So we'll end with the central question that this whole scenario poses. In a world where access to your own money is no longer a right, but a privilege, the ultimate power is held by those who grant that access. The crisis won't look like panic in the streets. It's going to look like a quiet, digital message on a screen, permission denied. The real question is, when that happens, who gets to give the permission, and who will be left waiting for it?